At 94, I've seen a thing or two, 15 recessions to be exact, and countless market crashes. I've navigated every economic challenge you can imagine. As we approach 2026, I'm seeing red flags that remind me of some of the most precarious times I've lived through. But there's good news. If you're already retired, or nearly so, there are 5 specific investments that can shield you from the coming turbulence. They can still generate the income and growth you need. These aren't flashy investments promising quick riches. They offer something far more valuable: protection for what you've worked a lifetime to build, coupled with steady, dependable returns to support you for the next 2 or 3 decades. I've personally relied on these principles to safeguard and expand my wealth through every crisis since the 1950s. Today, I want to share exactly what retirees should own before 2026. I'll explain why these specific investments are more critical now than ever, and detail how to position your portfolio for any economic scenario that lies ahead. The window to act is closing, so the time to make these moves is now, while you still have options. Why 2026 is the deadline? It's vital to understand why timing is so crucial before I reveal these 5 investments. We're at a unique crossroads in economic history, with several factors converging to reshape the investment landscape fundamentally by 2026. First, interest rates are at levels unseen in over 15 years, but their stability is questionable. The Federal Reserve is walking a tightrope between inflation and recession, making policy missteps likely. Second, the baby boomer retirement wave is gaining momentum. Every day, approximately 8,000 boomers retire and start withdrawing from the markets rather than contributing. This creates selling press that will intensify through 2026. Third, government debt has ballooned to levels that will force difficult decisions, either allowing inflation to diminish the debt's value or significantly raising taxes. Either path will negatively impact retirees. Early in my career, I learned that the best time to prepare for a crisis is before it hits. Back in 2006, I began shifting towards cash and safer investments because I saw the housing bubble inflating. Most people thought I was being overly cautious. By 2008, they understood. I'm seeing similar warning signs today, and the preparations I'm making for my own portfolio are the same ones I'm recommending to retirees. Investment number 1, Treasury Inflation-Protected Securities. The first investment every retiree should own before 2026 is Treasury Inflation-Protected Securities, or TIPS. Let me explain what they are and why they're essential right now. TIPS are government bonds that adjust their principal value in response to inflation. When inflation rises, your principal increases. When it falls, your principal decreases, but never below the original amount. You also receive interest payments that adjust along with the principal. Why is this so important? Traditional bonds are vulnerable to inflation. If you buy a 10-year Treasury bond paying 4% and inflation averages 5% during that period, you're actually losing purchasing power each year. But TIPS protect you from this erosion. If inflation spikes to 6%, your TIPS adjust upwards to compensate. Let me share a personal story about why I value inflation protection so highly. In the 1970s, I saw inflation devastate the retirement plans of people who had done everything right. They had saved diligently, bought government bonds for safety, and believed they were secure. But when inflation reached double-digit levels, their fixed income became practically worthless in real terms. Something that could buy a nice dinner in 1970 could barely buy a sandwich by 1980. I vowed then that I would never be caught off guard by inflation again. How to implement TIPS for retirees? I recommend allocating 20 to 30% of your bond portfolio to TIPS. You can purchase them directly from the government through treasurydirect.gov, or you can buy TIPS mutual funds or ETFs through any brokerage. The key is to ladder your TIPS with different maturity dates, so you have funds becoming available at regular intervals. This provides both inflation protection and liquidity. A word of caution: TIPS have tax implications. The inflation adjustment to the principal is taxable in the year it occurs. even though you don't receive that money until maturity. For this reason, TIPS are best held in tax-advantaged retirement accounts. Real-world example. Imagine a 65-year-old retiree with $500,000 in bonds. If they allocate $150,000 to TIPS and inflation averages 4% over the next 10 years, that TIPS investment will grow to approximately $222,000 in nominal terms, maintaining its purchasing power. Meanwhile, traditional bonds paying 4% would grow nominally but lose purchasing power after accounting for inflation. Reason 1. Inflation protection. Unlike bonds with fixed payments, dividend-paying companies can raise their prices when costs increase, allowing them to raise dividends. This provides natural inflation protection. Reason 2. Recession resilience. These companies sell products people need regardless of economic conditions. People still brush their teeth, Procter & Gamble, and take their medications, Johnson & Johnson. I learned the power of dividend-paying stocks from my mentor, Ben Graham, but I've refined that strategy over decades. The key insight is simple. Companies that consistently raise dividends are managed conservatively. They generate reliable cash flows and, importantly, prioritize shareholders. A company increasing its dividend year after year is essentially saying, we're so confident in our future cash flows that we're committing to pay you more every single year, regardless of economic conditions. That's the kind of business I believe retirees should own. My personal dividend strategy is a cornerstone, both in my personal portfolio and at Berkshire Hathaway. I focus heavily on dividend-paying businesses, not because I need the income, but because a company's dividend policy tells me everything I need to know about management's confidence. For retirees, I recommend allocating 30 to 40% of your stock portfolio to dividend aristocrats. You can buy individual stocks if you're comfortable doing the research, or you can buy an ETF that holds a diversified basket of these companies. The key is to reinvest dividends during your working years, then start taking them as income in retirement. This provides a growing income stream that helps offset inflation. Let's look at some real numbers. A $300,000 investment in dividend aristocrats, yielding 3% initially, would generate $9,000 in annual income. But if those dividends grow at 5% per year, within 10 years, your annual income would be approximately $14,650. And within 20 years, approximately $23,850. This growing income stream is what allows retirees to maintain their standard of living despite inflation. The third investment retirees must own is short-term Treasury bills, specifically T-bills with maturities of 3 to 12 months. Now, you might be thinking that T-bills don't pay much interest, and why would you tie up your money there? Let me explain why T-bills are crucial right now, especially for retirees. Advantage 1, safety. T-bills are backed by the full faith and credit of the U.S. government. They're as close to risk-free as you can get. In times of economic uncertainty, this safety becomes invaluable. Advantage 2, liquidity. With maturities of 3 to 12 months, your money is never locked up for long. This gives you flexibility to take advantage of opportunities or handle emergencies without being forced to sell long-term investments at the wrong time. Advantage 3, current rates. Right now, short-term T-bills are paying around 4 to 5%, which is competitive with many other safe investments and much better than the near zero rates we saw just a few years ago. Advantage 4, optionality. This is the big one. T-bills give you optionality. If markets crash or interest rates spike, you'll have cash becoming available regularly that you can deploy at better prices or rates. I call this dry powder, and it's been one of my most important investing strategies throughout my career. In 2008, when credit markets froze and stocks crashed, I had billions in cash and short-term securities. This allowed me to make some of my most profitable investments like buying Goldman Sachs preferred stock yielding 10%, investing in General Electric, and buying Bank of America warrants. These opportunities only existed because I had cash ready to deploy when others were desperate for liquidity. For retirees, I recommend keeping 15 to 25% of your portfolio in short-term T-bills. This might seem like a lot, but this allocation serves multiple purposes. It's your emergency fund, your opportunity fund, and your sleep-at-night money all in one. You can buy T-bills directly from treasurydirect.gov or through any brokerage. I recommend laddering them with different maturity dates so you have money becoming available every month or two. There's another advantage to T-bills that's harder to quantify, but equally important. They let you sleep at night. When markets get volatile and the news gets scary, you can look at your T-bill allocation and know that portion of your wealth is completely safe and liquid. This psychological comfort often prevents panic selling at the worst possible time. I found that the investors who do best during crises are those who have enough safe, liquid assets that they never feel forced to make desperate decisions. The fourth investment is controversial, but I believe every retiree should consider it: immediate fixed annuities. Now, I know annuities have gotten a bad reputation, and much of that reputation is deserved. Many annuities are complex, expensive, and designed more to generate commissions for salespeople than benefits for buyers. But immediate fixed annuities are different, and they solve a problem that nothing else can: longevity risk. An immediate fixed annuity is simple. You give an insurance company a lump sum, and they guarantee you a fixed income for the rest of your life. The biggest financial risk retirees face isn't market crashes, it's actually living too long. Imagine retiring at 65 and needing your money to last until you're 95. That's 30 years. But what if you live to 105? I saw this play out in my parents' generation. Those with pensions guaranteeing monthly income live much more comfortably than those relying entirely on savings, even when the savers had more wealth. That's why I've come to appreciate immediate fixed annuities. They transfer the risk of living a long time to an insurance company. You simply can't outlive them. Here's the approach I recommend. Around age 70 to 75, consider taking 20 to 30% of your retirement savings and buying an immediate fixed annuity. The goal is for it to cover your basic living expenses: housing, food, health care, utilities, in combination with Social Security. Everything else, like travel, gifts, and luxuries, can then come from your investment portfolio. This creates a financial floor, a level below which you simply cannot fall. For example, a 70-year-old with $500,000 might put $150,000 into an immediate fixed annuity. Currently, that would generate approximately $900 per month for life. Combined with Social Security, say $2,500 per month, they'd have $3,400 in guaranteed monthly income, regardless of market conditions or how long they live. The remaining $350,000 stays invested for growth, flexibility, and handling unexpected expenses. A few important cautions. Only buy immediate fixed annuities from highly rated insurance companies, A+ or better. Only work with fee-based advisors who don't earn commissions on the sale. And never put all your money into an annuity. You need liquidity and growth potential too. But for creating that financial floor of guaranteed income, immediate fixed annuities are a powerful tool. The fifth and final investment I believe retirees must own is a basket of utility and consumer staple stocks. These are the businesses that provide electricity, water, and gas, the utilities, and the companies that sell products people buy regardless of economic conditions, the consumer staples. Think Duke Energy, NextEra Energy, Southern Company for utilities, Procter & Gamble, Johnson & Johnson, Walmart, and Costco for consumer staples. I know, these are boring businesses. No one gets excited talking about their electric utility stock at parties. But boring is exactly what retirees need. These businesses have inelastic demand. People need electricity, water, toothpaste, and groceries, whether the economy is booming or collapsing. This translates to steady revenues through all economic conditions. They also have pricing power. Utilities are often regulated monopolies, able to raise prices to cover cost increases. Consumer staple companies have strong brands that allow them to pass inflation costs on to customers. This provides a natural inflation protection. These businesses also generate steady cash flows, which allows them to pay consistent and growing dividends. Many are even dividend aristocrats. And during market crashes, these stocks typically fall less than the broader market. During recoveries, they may rise less, but that's fine for retirees who care more about preservation than growth. I've held businesses like these throughout my career. Coca-Cola, which I bought heavily in the 1980s, is a perfect example of a consumer staple that generates reliable cash flows through any economic condition. For retirees, I recommend allocating 20 to 30% of your stock portfolio to a mix of utilities and consumer staples. You can buy individual stocks or use sector ETFs for diversification. The key is to focus on companies with long histories of dividend payments, strong balance sheets, low debt, essential products or services, and for utilities, regulated monopolies. For example, a $300,000 stock portfolio for a retiree might allocate $90,000 to utilities and consumer staples, 30%, $120,000 to dividend aristocrats, 40%, and $90,000 to a broad market index fund, 30%. This provides a balance of safety, income, and growth potential while minimizing the risk of catastrophic loss. Now, how do we put it all together? Let's consider a complete retiree portfolio. Assume you're a 65-year-old retiree with $750,000 in savings. Here's how I would structure it. I'd allocate 40% or $300,000 to bonds. Within that, I'd put $100,000 in tips with laddered maturities, $125,000 in short-term T-bills with a 3 to 12-month ladder, and $75,000 in high quality. In retirement, I've learned that the priority shifts. It's no longer about building wealth, but preserving it, all while generating income. That's why these 5 investments I've been discussing are so crucial. They won't make you rich overnight, and they certainly won't give you exciting stories to share. But they offer something far more valuable. Let's talk about some of the specifics. For example, with a $750,000 portfolio, you might expect approximately $12,000 a year from bond interest, figuring around 4% on $300,000. Then, perhaps $9,000 from stock dividends, estimating 3% on another $300,000. And once initiated, maybe $12,000 from annuity payments. That's roughly $33,000 in annual income, or about $2,750 each month before Social Security. Combine that with Social Security, and most retirees, in my experience, would have a comfortable income while preserving their principal. Now, why before 2026? Several factors are converging around 2025 to 2026 that will significantly alter the investment landscape. First, there's interest rate uncertainty. Current T-bill and TIPS rates are attractive, but they could shift dramatically in either direction. If you wait and rates drop, you'll miss out on today's yields. Conversely, if rates spike due to a crisis, quality bonds may become harder to access. Then consider stock valuations. Quality dividend-paying stocks are reasonably valued right now. A market crash might offer better prices, but you'd be buying during a panic, which makes sound decision-making more challenging. If markets rally, you'll simply pay more for the same quality. Annuity rates are another factor. They're directly tied to interest rates, and current rates are the best I've seen in maybe 15 years. If rates fall, annuity payouts will follow. Policy changes are yet another consideration. Tax laws, retirement account rules, and even Social Security benefits could all undergo significant changes in the 2025-2026 timeframe. Positioning yourself now under the current rules provides a degree of certainty. I've found that the best time to prepare for uncertainty is when you have the luxury of time and options. Once a crisis hits, your options narrow, and decisions become forced rather than freely chosen. One final critical point. These 5 investments aren't a set-it-and-forget-it strategy. You need a rebalancing strategy. I recommend reviewing your portfolio quarterly and rebalancing it annually. If stocks have performed well and now represent, say, 50% instead of 40% of your portfolio, sell some and buy bonds to return to your target allocation. If T-bills are maturing and you don't need the cash, roll them into new T-bills or perhaps deploy them into stocks if they've declined. And if your dividend-paying stocks have raised dividends, decide whether to reinvest those dividends or take them as income based on your current needs. This disciplined approach forces you to buy low and sell high automatically without trying to time the market. I've used this exact strategy for decades, and it's one reason I've been able to compound wealth effectively while avoiding catastrophic losses. I've watched too many retirees chase returns in their 60s and 70s, taking risks they couldn't afford, only to find themselves at 80 or 85 with far less security than they should have had. Don't let excitement rob you of security. Don't let greed overcome prudence. Don't let the fear of missing out destroy what you've spent a lifetime building. Own these 5 investments before 2026. Sleep well at night, knowing you're prepared for whatever comes. And spend your retirement years enjoying life rather than worrying about money. That's the real return on investment that matters.